It looks like the Fed is now making it official. Prepare for more inflation. But don't worry, it's only temporary. You came here for the truth, so let me unveil that for you. This is what we need to know. Number one, Fed inflation. We're going to talk about that in today's video, and it is so key to understand. Number two, we're going to look at New York. I know I have many subscribers from New York. I've got a video to show you. I want to give you some insight as to what's happening, and perhaps you can give me some insight as you have your boots on the ground. And number three, we're going to talk about debt. This goes on all different levels. I'm going to show you some fantastically frightening charts. So we'll get into all of that and more. Let's go. This article here is basically talking about Neil Kashkari, the Fed president, what he had to say, and oh my goodness. Quote, basically what's happening in the US economy went through a very abrupt shutdown a year ago. Now it's going through a reopening, and you're seeing many sectors of the economy struggle to make that adjustment. This is true. We've seen that. I've documented that here, and I'm sure you know that as well. But this is the part that to me is quite shocking, because he's not the only one to suggest this. We have Janet Yellen. Let me just get into it, okay? No ranting. I'm not seeing any evidence yet that we're going to have sustained high inflation beyond this reopening period. So if you cut it right there at that quote, okay, temporary, transitory, use all those names. Whether that's 6 months or a year or 18 months, I'm not sure. 18 months of high inflation, whenever you get those periods, high inflation for 18 months, the likelihood of it persisting further or creating lasting damage through that period is extremely high. But don't worry, because that just means it's, things are a little bit more expensive. No big deal, right? Well, for a lot of people, in fact, millions of people, it is a big deal. So I know that a lot of people have suggested that I should shut my mouth about this, but there are millions of people who are, quite frankly, not being represented. And I've got to do what I can to share the knowledge. I think it's really, really a disservice to the people when they don't get to hear what's actually going on. They might think it's just them. Well, it's just me, I guess. I guess something's wrong. No. This is all created by the Federal Reserve and the stimulus packages that actually make inequality much worse every day. Take a look at this out of the AP. We don't see it stalling out or reversing, but it's clearly aging, talking about the sort of the economic rebound. We have this whole deceleration theme going on that the best is yet to come is not the case anymore. We have definitely peaked. And so we should have expected that regardless, because you can have a GDP number, and this is their fake numbers anyway, going up at 10% or 20% or all of these things. Of course, it has to come down back to earth. The unknown of what you're going to do looms large. We've been riding this humongous reopening economy and reflation trade. Yes, it's going to slow down, but what is it going to slow down to? If the job market is still weak, do we slow down to something on the order of 4% or 5% of economic growth, or does it slow down to 2%? That would be a negative surprise that could roil the bond markets and the stock markets. And to me, that's huge. So you've got to take all of this in. It's a whole package. You can't just look at the stock market. You can't just look at ETFs. You can't just understand that your 7 shares of Amazon are going to be the be-all, end-all. No, there's more to it. Now look at this here. I can't show you the actual video itself, but this is it. NYC's, New York City's, reopening, but businesses aren't coming back. This is a 49-minute video where this guy here walks around Midtown Manhattan and is boarded up all over the place. This to me, and as he suggests, is quite frankly a very bad thing for commercial real estate. And then you go a step further, something I've talked about many times before. All of this is connected to debt. And that debt has a lender associated with it. If those people can't pay up their debts, that lender's going to have to basically pay up in a way. Who are they going to get the money from? Or are they going to default? Are they going to default on the amount of debt? The derivatives that are connected in with that may spiral out of control. Will it be contained to just commercial paper, commercial debt, or will it become a problem in other markets as well? I really don't know. But last time the subprime crisis wasn't contained. They told us it would be, but quite frankly, it wasn't. All sectors, debt securities and loans, liability level over the gross domestic product, okay? All I'm trying to show you here, you could see that, throughout a period, this was actually starting to decline from the financial crisis. And then as soon as we got to 2020, it spiked upward. All I want to show you here is that debt is accelerating. It's accelerating at all different levels. Non-financial, business, debt securities, and loans. This has absolutely surged in 2020. And we know that to be the case. This is something that, generally in a recession, you're supposed to deleverage, but the exact opposite happened. And this is, we're going to have to pay the price. Markets are disconnected from the economy. And we know this to be the case, but here it's documented, just showing you the S&P 500. This is the cumulative S&P 500, 200% growth. And looking at that, the way that it's showing you here. But the point is, if you look at the real GDP growth, the purple line, 23.57 over this, by the way, it's from 2007 up until the present. And it just gives you a different look at the prices that you're paying for stocks, essentially, the growth that we've seen in stocks. And we compare that to the growth in the actual economy. Something truly does not add up today, and it's a big mess as a result. Number one, the Fed is now suggesting that inflation will persist for longer. It's not just the Fed. We have had many of the big economists around the world talk about it. We've had Janet Yellen talk about it, and so on. Number two, real assets perform the best during an inflation. It's hard to be able to time it, but historically that's been the case. Number three, watch the actions of the central banks around the world very carefully. What are they doing with their money printing? What are they doing with their buybacks of stocks, all the purchases? What are they doing with their interest rates, open market operations? All of this is absolutely key. It's pivotal. In 2021, we've already seen 21, by my count, 21 rate hikes globally. Keep an eye on it. There's a lot on this chart here from Real Investment Advice, but I just want to show you really quickly. Real household equity ownership, real GDP ratio by brackets versus the Fed balance sheet. And essentially what we're looking at, let me pull out the highlighter here, is the yellow portion. This is the real 50 to 90% equity ownership. And you can't even see it, but the blue down here is the real bottom 50% equity ownership. It's just a dot, okay? So the bottom 50% effectively owns nothing. If you look at the 50% to the 90%, or even, hey, let's take it, the bottom 90%, they own, in this manner, a very small percentage of the total. And you look at this, the total of assets, but when they're relating it to the Fed's balance sheet, it's just an interesting way to look at it. Household on the left side, by the way, household equity ownership to GDP ratio by brackets. And it just kind of gives you some insight. So this black line, by the way, is the Fed's balance sheet, if you can't see that there. What does this tell us? Like I've said before, you can measure it through different ratios and so on. The top 1%, which is this right here, own everything. They own it in dollar terms. They own it, just comparing to the rest of the population. They own it compared to the GDP. However you want to look at it, the top 1% own the most, and the higher up you go, you see the great disparity, because you even break down the 1% further into the 0.1% and 0.001% and 0.0001%, and you get the picture. And the whole point here is that the higher up the food chain you go, you start to realize who is really in control, who is making the decisions. It's not really the 1%, but they're included in that. Fed requires debt issuance. This is interesting. So they make the case, by the way, that money printing and essentially where we're heading, this is real investment advice, where we're heading is deflation, not inflation. And I think we need to address number one, what is inflation? If you look at it as in price inflation, you might see something different when you look at it in terms of actual expansion of the money supply, and is what's going to happen in the near term, or are we talking about long term? Like there's many different things that need to be addressed here. Anyway, of course, the Federal Reserve requires debt issuance by the government to facilitate quantitative easing. Since the financial crisis, this is insane, total government intervention surpassed $43 trillion into the economy to keep it afloat. There is no possible way that this system is sustainable. It's just fact. Monetary policy is not expansionary. And what you're looking at here, the black line, that's the Fed's balance sheet. Okay, it's been going crazy, as you know. Loans, and the blue line is loans and leases and bank credit, all commercial banks. So the actual total amount of loans, and you can even take it back further from 2020 and see what had been happening. I mean, it just gives you this idea that as they pump more money out, it doesn't necessarily make its way out into loans and to, giving out to businesses and so on. Bank loans and leases versus monetary velocity. And you're seeing kind of the same thing here. The monetary velocity has declined. And by the way, just a quick pointer, this is the monetary velocity. And by the way, I had said I will keep you up to date on it. It did spike up just briefly, but now has continued to come down. We'll see as the trend continues on and on. And again, same one, the orange is the loans and leases and bank credit, all commercial banks, just giving you an idea of what's been happening there. And clearly, the banks are not loaning it all out. Okay, what they're doing is they're parking it at the Fed. Right now, reverse repo operations over $800 billion as of Friday. So it's a mess. It's an absolute mess. Wall Street has surrendered to the $500 billion ETF rush. Vanguard leads the way as industry prepares to shatter annual records with months to go. They absolutely will. You could see this here, the flow show. ETFs just had their best first half of inflows on record, just skyrocketing. We'll see what happens. Looking at this a little bit further, they got some charts in here to show battle for the assets. Way more money is going into ETFs than mutual funds. Why? Lower fees, and in many cases, actually better returns in a lot of these ETFs, depending on which one you choose, particularly with Vanguard, something like that. BlackRock, Vanguard, and State Street make up a majority of the ETF industry. You could see that pie chart here. And then there's another one that I wanted to show you, the Cathy effect. Active ETF launches now surpass passive debuts. So things are changing real fast, the way that we see this. They're using it as an ETF because people can get in easier. Okay, I'm just going to buy that ETF. But the fees that are there are going to be different. There's a different structure with that, okay? There's a bunch of things that, quite frankly, I didn't have time to get to. Retail sales are increasing in this case here, but consumer sentiment ebbs. So there's a grand disparity that's taking place, okay? Watch out the kind of information that you are, picking up on, okay? Because it's always two-sided. And another one, I know you guys like the coffee GPS, so I just wanted to bring this up to you. I posted on Instagram and Twitter and so on, but this right here just shows you the most purchased caffeine beverage by country. Now, why am I showing you this? Give me a second. Looking at Canada, US, Europe, Finland, Japan, it breaks it all down, and you could see which caffeinated drinks people drink depending on where they are. Okay, and talks about the imports and exports, and that's what I wanted to mention, was that we need to understand what comes into different countries and out of different countries. That makes us smarter investors, because if we understand how that works and we understand the supply chain better, we're going to be better investors. We're going to understand the world better. We're going to be able to dissect information that comes through a website like Bloomberg. Instead of just reading it, scanning, okay, great. No, we can, oh yeah, well, right. Copper, that happens with copper. Well, I know that in Chile, they're a big exporter of copper, and suddenly that gives me insight I wasn't able to know before I learned that. So get with the program and expand your knowledge, because the number one asset that you have beyond all else is yourself. Invest in yourself before anything else. If you want the truth, if you want the details that quite frankly are unavailable in the mainstream, and I gotta say it, a lot of the alternative is just wasting your time. And so this information is going to be available to you through the insiders. The insiders is my way to email you directly, for you to email me directly. And of course, we're gonna go around their systems because they're locking it down. They're shutting me out. I am under the shadow ban program that they have. That's fine. I'm doing this to get around it. TheMoneyGPS.com, of course, it's free. If you haven't already, hit that thumbs up button. Come on, you gotta do that. You gotta subscribe to the channel. We're trying to get this channel over 300,000 subscribers in the near future. Come on, join the program. Let's get on it. Let's do this. Hit that thumbs up, hit that subscribe. And if you haven't seen this video yet, you gotta check it out. Click it and I'll see you there.